Good morning, everyone. This is Renee from Epstein Financial. Krista and I are really excited about being able to do this webinar version for you today. We wish we could see you all in person in the office, but with everything being the way it is, this is the best way to get all of this information out to you. Just so you know, on the call, we've got everybody muted, so you're not able to speak. We won't be able to hear you. But there is a question box, so if there's anything that comes up during this call, just feel free to type in your questions, and Krista and I will make sure to read those all to Michelle when we get to the Q&A time.
All right, great. Hi, everyone. This is Krista. Thanks again for joining. We really appreciate you taking the time out of your morning. It's been an intense couple of weeks for everybody, and we know that there's a lot of information being thrown at you left and right. And I, in fact, will probably be sending you all another email this morning with more information on loans for small businesses, so look out for that. But without further ado, I'd like to introduce Michelle Marsh. Michelle is the owner of Retirement Plan Concepts and Services, which some of you may be familiar with. Jennifer Deffenbaugh is also on the call as well, and she is our go-to amazing person from our PCSI. But Michelle is going to break down what's going on with the CARES Act and the potential impact that you can have on your plan and how that might help you and your plan participants with the financial hardships that are happening with the CARES Act. So I'm going to go ahead and mute myself so my cats and my daughter don't get in the way of the call. And without further ado, Michelle, take it away.
Well, thank you so much, Krista and Renee. It's my pleasure to be here speaking with everybody and sharing this very new information. As we all know, this act was enacted on Friday late, about 5 o'clock. We did get a piece out right after, I think it was in our clients' hands by 7 o'clock or so. But you know, even this week, I've participated on a couple webinars. I have a couple more. So, you know, we're continuing to decipher this. So what I have to share today is our best knowledge that we have as of right this minute, subject to potential modifications or changes as we work through it all. What I want to do is kind of go through and give you in a capsule what's available, what does it mean, some things to consider, and some things that I've heard recently, as recent as yesterday. And then, as Krista said, we'll open it up for questions. So what the CARES Act did as it relates to retirement plans is really to try to make some account dollars available to participants if they have a qualifying coronavirus related issue. So first I want to address what those coronavirus related issues are, because other than a couple minor things, the top two things I'm going to talk about only would be available, one, if the plan sponsor chooses to make them available in their plan, and two, if the participant is considered eligible or a qualified individual. In the law, it actually says a qualified individual. So to be a qualified individual, you either have to be diagnosed with the coronavirus, you have to have a spouse or dependent that has been diagnosed with the coronavirus, you have to have experienced adverse financial consequences due to a quarantine, a furlough, or a layoff due to the coronavirus, or a reduction in work hours, or a business closure, or you have to be at home providing childcare for your children that are home because the schools are closed and or daycares are closed, all because of the coronavirus pandemic. So those are the participants that can benefit from the different elements that were made available through the CARES Act. So first, they have to be a qualified individual. And the employer has to decide to put these features in their plan. So once those two things are taken care of, then the features that are available are two different ones. One is, actually, I guess three, sorry. One is a new type of in-service withdrawal. So this withdrawal is just a distribution out of the plan. Again, the employer can decide whether they want to allow it from all sources, specific sources, just like you do any other in-service distribution. But it is considered a coronavirus-related distribution. The maximum that can be taken out of the plan is $100,000. It is not subject to the traditional normal mandatory 20% withholding. And it is also exempt from the 10% early withdrawal penalty. So typically, if a participant takes money out of the plan prior to age 59 and a half, not only do they pay ordinary income tax, but they do have an extra 10% early withdrawal penalty, and that is waived for this type of distribution. It does remain taxable income, subject to ordinary taxes based on the individual's filing status. And like I said, it is not subject to the typical mandatory withholding of the 20%. So in essence, someone could come in and take $50,000 and have nothing withheld from it. They could get that full $50,000 in hand out of the plan. It can, however, be indirectly rolled over back into the employer's plan or any employer's plan or an IRA within 3 years from the date that the distribution is taken. And that would come back in as a rollover. So it does not come back in sourced. So let's say they took it out of their deferral and their match and their profit sharing. When it comes back into a plan or an IRA, it is just coming back in as if it's a rollover. And for amounts that aren't directly rolled back into an IRA or the employer's plan or another employer's plan, the taxes may be paid either in the year that they take the distribution, which would be 2020, or they can spread those taxes ratably over 3 tax years. So there's some relief, not only on the upfront tax withholding, but also trying to either delay paying tax on the amount that you take or avoiding the tax by putting it back into a retirement plan or an IRA. So that's kind of the specifics for that coronavirus related in-service distribution. The next area all relates to loans. So one, if you are a qualified individual and your plan allows for loans, the employer can again decide to allow an increased loan limit up to $100,000. So currently, we all know if you have loans, the max someone can borrow is $50,000, but that can be increased to $100,000. And additionally, typically that loan limit is determined based on 50% of a participant's vested account balance. And again, that 50% can be increased to 100% of their vested account balance. In addition, this loan, when taken, can be deferred for 12 months, meaning they could take the loan today, but not start payments until April 1st of 2021. Note that interest will still accrue even if the payments are delayed. The good thing about this is typically when you have furloughed employees, it becomes a party in interest transaction to allow them to borrow from the plan when you know that they can't make a repayment because they aren't getting a paycheck. This 1 year delay in starting repayments allows for individuals who are on temporary furlough or temporarily laid off due to the coronavirus related issues to go ahead and borrow money from the plan because it's expected that they wouldn't need to make any payments for 1 year. Now, a caution is obviously if after all of this is over or somewhat over and people start getting called back to work, if indeed that participant ends up being terminated, then they potentially would not be able to pay back the loan, and it could cause them to have an unexpected taxable distribution. The other area that they provided relief on loans is related to existing loans. So if your plan allows for loans already and you have participants with loans, but their hours have been cut back or they have been laid off or temporarily laid off and they can't make those loan payments, to avoid them going into default, this CARES Act allows a 1 year delay on loan payments for 2020. And let me back up, I'm sorry. On the other loans, they're only available for the next 180 days, so for 6 months. After that, a participant cannot come in and request this increased loan. On the existing loans where you may allow participants to suspend their payments, again, the same thing will happen. The interest will still accrue, but their payment will be stopped for the rest of 2020, and then however many payments remain will be added on to their loan and extended. So in essence, if you do have someone who just took out a loan at the first of the year, and it was a 5-year loan, this law will allow it to go to a 6-year loan. Now, it will be a little tricky because timing wise, those loan payments, again, let's say a participant decides today that they've been affected, they qualify, they want to stop their loan payments, and the plan has decided to allow for that. So they come in, they stop their payments on April 1st. So their payments from April 1st to December 31st of 2020 will be stopped. Then starting in January of 2021, their normal payment will need to start again, even though their delayed payments have been pushed. And then in April of 2021, because of the accrual of interest, it's advisable to re-amortize that remainder of the loan. Otherwise, they'll end up kind of with a balloon payment at the very end from the accrual of interest that they weren't paying, which will end up greater than the interest had they continued to make every payment. So, there's some administrative nuances to it, but the bottom line is, from a relief for participants, the plan can allow existing loan payments to be suspended for the remainder of 2020, and then those would get added back to the loan and extend the loan. So, again, I think their payment will increase just a bit because of the increase in interest they'll owe, but it wouldn't be like trying to still repay it in 5 years. You do get that extra number of months. Obviously, at this point, the most number of months someone would really get is 9 months added to their existing loan. The other item, which was in the act, is really the suspension of the required minimum distributions. We're still trying to get some clarification whether this is mandatory or elective. I've heard it both ways. I've heard that it's a participant can elect, but I've also heard that a plan sponsor can decide they're going to just suspend RMDs. Additionally, the act did allow someone who may have already gotten their RMD before that law passed, that they can roll that RMD into an IRA and avoid paying taxes on it. So the big issue with the RMDs was more related to the decline in the market, which we did see that in 09 when the market was down in 08, because the normal RMDs are based on 12/31 prior year balance. And so you take that balance and figure out what the RMD is. And because everyone's balances are down 20 to 30%, automatically their RMD would be inflated based on where their values are in the market or in their account balance today. So that element was primarily due to the decline in the market, less related to obviously trying to get money into participants' hands. So we are still trying to get clarification. Again, I was on 2 different webinars yesterday, and one webinar said, that they may, that they're not required to take the RMD. And one webinar said that basically RMDs are not to be paid out. So more on that to come. But the bottom line is, one, if you missed any, or if participants are concerned that their RMD is going to be inflated, the bottom line is they won't even have to take it. And if they did take one that was for 2020, they can just roll that over to an IRA and not pay tax on it in 2020, and allow it to continue to grow. There were a couple minor things for defined benefit plans or cash balance plans. Typically, you must fund your cash balance plan by the due date of your tax return with all extensions. So for a 12/31 plan year in, that deadline is typically September 15th of the year following the plan year. So a 12/31/2019 plan year would have been required to get all their funding dollars into the plan by September 15th. And that was extended in essence to the end of the year. It's really required by January 1st of 2021. Obviously, the markets aren't open that day, so you'll have to get it paid in by the last day of 2020. And then just some things to think about. Well, let me tell you about timing of plan amendments. So your plan can offer all these things. There isn't a official amendment to be signed right this minute. And actually, there's not a requirement to have one until the end of 2022. If you're a corporate or non-for-profit, if you're a governmental, it's actually not until the end of 2024. So the requirement to have all this language officially in your legal plan documents is delayed. But most practitioners and vendors are probably going to want some sort of confirmation signed. I know our practice is to kind of have a amendment request form signed, just so we know what elections were made, so we can track them. And then when it's time to prepare the legal documents and get them out for signature, we've captured what elections were made. So you can add these things and they'll be there. You just probably will not have any legal document. Typically, when you add something, you have an SMM to pass out, which is a summary plan or summary material modification. You will not have that. So communication to participants would just be on the employer to let participants know that they've added these features to the plan. So some things to think about as being a plan sponsor. If your plan already allows for hardships and loans, participants still have to qualify for hardships under the regular rules. So they may not have medical expenses yet. They may not be foreclosing on their house. What the in-service coronavirus related distribution does is allows them to get to money before those things start happening, so they don't have to worry about, possibly needing a hardship. But if you've been able to maintain your workforce, everyone's able to work remote, no one's sick or has come to you and said that they've had an issue. I think most people across the country are affected by the children at home. And obviously, you probably don't know about their whole family situation. But to run in and just add these so they're there may not be the smartest decision. Obviously, this is what we refer to in the business as a leakage out of retirement plans. So at the end of the day, it is impacting, their ability to retire when they want to, if they withdraw these funds. But at the same time, we want to make sure our employees can put food on the table and take care of their expenses. I know we had a client before this act passed that had laid off 1,000 employees because they're a restaurant, and they called us and said, what can we offer our employees? What can they do? At the time we didn't have any of this, and unfortunately we said there's not much you could do. With this relief now, they can offer those employees some access to their accounts. Increasing or offering the in-service withdrawal provision, that is just a one-time temporary provision. So it will exist from the time you put it in through the end of the year. So once we get to 2021, that really is no longer an active provision in your plan. So it really is kind of a one-time issue. And again, as I mentioned with the loans, a new loan taken out for this has to occur in the next 180 days. I think the other thing, to be cautious of is I've already seen 2 vendors who are making these features defaults in retirement plans, and then sponsors are having to go back in and opt out if they don't want them. This happened when the hardship rules changed at the end of 2018 going into 2019. Most vendors just defaulted the hardship rules based on how the law was written, and if an employer didn't want to follow those, they had to go back in to their investment provider and say, hey, wait, we don't want those. So I know for sure that Fidelity has already done this, and I believe, ironically, that yesterday was the date that you were supposed to tell them that you didn't want them. We don't really have Fidelity plans, so I didn't get those notifications, but I certainly hope that the employers did, but I'm not sure that they would have understood what they were talking about. So I would be cautious of your vendors, and rather they just default in, these into your plans, because one, if they default them, then you would be mandatorily required to get an amendment at the end of 2022. But also, if they default them and you didn't want them, then participants could potentially get those benefits before you go back to your vendor and say, no, I don't want these features. I sort of mentioned on the coronavirus related in-service withdrawal that you can pick and choose sources. So just like other in-service hardships, 59 and a halves, you can say they can only take their deferrals. You can say they can take it from all money. Again, a caution, a lot of plans are written that when a participant takes an in-service, it is only from accounts that are already 100% vested. And I do know that we write almost all of our plans that way. It's just an ease of administration and tracking issue. So let's say someone has, 25,000 in their deferral account and they have another 25,000 in their match account, but they're only, 50% vested on their match account. Well, if your plan says that to take an in-service, you have to be 100% vested, the only source that would be available to that participant is their deferral source. Even though they're partially vested in their match, they could not take any of the dollars out of it because the plan says that you must be 100% vested in the source that you're going to withdraw from. Again, that's a change that can be made, but be cautious because that's a protected benefit. So once you decide you want to allow in-service to come from partially vested sources, that will remain in your plan going forward because it would not be tied to this specific type of withdrawal. It is a plan level election that once changed is protected and would have to remain in your plan going forward. Also, for the in-service, there was a caveat in the law that said that any distribution paid in 2020 could be treated as a coronavirus-related withdrawal. So in essence, they were saying for this in-service, if a plan chooses to offer it and there were participants affected prior to the enactment and monies were taken out, then those could be treated as coronavirus-related withdrawals. Now, I'm not certain from a reporting perspective how vendors are going to capture that, and participants may just have to self-report. The other thing in regards to the qualified individual, plan sponsors can rely on certification from the participant. So again, I mentioned that we are creating forms not only for the amendment request, but we're working on, in essence, an author or a confirmation form from a participant where we have in there, I hereby certify that I am a qualified individual based on this criteria. So the sponsor does not have to go determine if they're sick or their spouse is sick or, any of those types of things. You can rely on the participant's certification that they do qualify. Another item as far as loans, if your plan only allows for one loan and you want to now bring in this element of this new coronavirus related loan, for participants that already have a loan outstanding, they could not take another loan unless you amend your plan to increase the number of loans to 2. So keep in mind that by adding that type of loan, that coronavirus related loan, does not increase the number of loans that your plan allows. And so again, if you already only allow one loan and you have participants with loans, if you add this other reason to take an increased loan, anyone with a loan would not be able to take it unless you do increase it. And again, I mentioned that these were options to increase to that 100,000 from the 50, and it's an option to increase from the 50% of their vested balance to the 100%. And all those things can be done separately. So, you could elect to go to 100,000, but still have it be 50% of their account balance. You could keep it at 50,000, but allow up to 100,000 or 100%. So they're all kind of individual elections. And then the other thing, kind of with the in-service, some plans specify what sources are available for loans to be taken from. So if your plan says you can only take loans from your salary deferral account, then you would have to add other sources. Otherwise, they could only take loans from that source. Additionally, if your plan says that loans are only for hardship reasons, which again, we have several plans like that, then you would need to remove that piece to allow for a loan, because the coronavirus related is not defined in the hardship definitions. I think that's all I really have. I know I've thrown a lot at you, but hopefully we have a lot of time for some questions. And I think we can open it up for that if you want, Krista and Renee.
Sure. I'll go ahead and read you the first question then. If a plan decides that they want to wait to adopt any of these provisions, until they see if it's something that's going to be needed within their company, if they do decide they want to add them, how much advance notice needs to be given, to RPCSI to put that into the plan?
Well, for our team, we're pretty quick about getting the request out. So, but the second piece is us letting the investment provider know. Again, I've been on only 2 calls. We work with about 10 different investment providers. The 2 I was on yesterday, they are scurrying and trying to get ready to prepare for these distributions. So from our end, I would say, we would probably need just a couple days, because we're just going to send out a form. You're going to make those elections, which you probably would have already talked to your consultant about, and that form comes back. As soon as that form comes back, we will be notifying your investment provider what elements that you want to make available, and then it's on, based on their timing of how quickly they'll be able to make those distributions. So for us, I'd say we only need a couple days notice. In reality, I would say you're probably looking at 5 to 7 business days before a participant could go in and make the request for the withdrawal.
All right, we have a second question then. If a plan already has 2 loan options, can they increase that to 3?
Definitely. There's no limit to how many loans that a plan can allow. It's just obviously how many the employer wants to be tracking and having in payroll and those types of things. So a plan does not have to limit the number of loans. We do have a couple plans that basically there is no limit on their loans. But yeah, you can increase that limit to wherever you want it to be.
All right. We have another question. So is it possible to adopt one provision now and then decide to adopt others later if needed? So for example, adopt the suspension of an existing loan repayment now, and then later on adopt the hardship limit increases later?
Absolutely. So we just had that yesterday. So we had a client who chose to just adopt the suspension of existing loans at this point. And then, they're trying to wait and see if they need any of those other elements. And since the actual legal amendment won't be prepared and executed until 2022, our process would be just to track as they add the elements, and then we can incorporate all those into the one amendment. Now, if I know some people aren't necessarily our clients, so if you don't work with RPCSI, I think you need to have that conversation with your provider, whether you're full service at a investment provider or if you are working with a different third-party administrator, because their process may be different. They may want a one and done, but we're flexible. Like I said, because this ends up as leakage, We're a little paternalistic about that. You know, we prefer retirement plans are for retirement. So if it would just benefit to allow participants to stop making their loan payments and you're good enough with that for today, then I would recommend you only do that. And then if the need arises, you know, for any of the other features, then come back in and add those as needed. Now, keep in mind that the increased loans are only available for the next 180 days. Everything else, you know, is really to the end of the year.
Okay, next question has to do with the child care and how that becomes a qualified event. Is that just when an individual has to watch their children and not work? Is that the key for the hardship, or just that their children are no longer in child care?
Yeah, so the wording is that the participant cannot work due to the unavailability of child care because of the pandemic. So again, most child care, I know pretty much all my employees that have children are affected. One, their kids are at home because they're, you know, the schools are closed and the child care places are closed. So, you know, we have a stay-at-home order. So, you know, the kids are home with their parents. And if you're not able to go to work, so again, our employees are working remotely, but if I would not have made that available, and so they would have just had to be home with their children, then and not work, then they would qualify. So they cannot be, you know, in essence, cannot be working due to not being able to have childcare for their children.
That kind of brings me into the next question. So I have been chatting with Jen on the side here, and she wanted me to note that employers should not be marking their employees as terminated if they're actually furloughed or laid off. Can you kind of elaborate on that a little bit?
Absolutely. So again, this comes back to your reporting, mostly to your vendors, and thanks for bringing that up, Jen. So, you know, if you send in your payroll report and you've marked everybody as terminated, when maybe they're really on a temporary furlough or temporary laid off, the issue is most of these provisions are for active participants. So if you terminate them and then they go to the, well, if you terminate them, then they're no longer active and these provisions would not be made available to them. Secondarily, if you terminate them, most of the investment companies, you know, put that in their system, and then that would allow the participant to go in and just withdraw their account, but they don't get any of the suspension of the 10% penalty. They don't get the, you know, they would still have the mandatory 20% withheld out of their check. So it, you know, and they would start the clock on a loan that isn't getting repaid. And so it's important that if they aren't terminated, they're on temporary furlough, laid off, you know, there's an intent to bring them back at some point, then you should not be reporting them as terminated.
Going along with participants and whether they're active, terminated, I know you elaborated a little bit earlier on notice requirements. Can you just kind of expand on that a little bit? I know if the plan is making changes, if they're going to be adopting any of these, what do they have to tell their employees? How are notices, which notices are going out, and also how are they distributed? If employees are furloughed and they aren't using company emails, what's the best way to be in touch with employees?
Right. Well, so that's part. So one, the summary of material modification that typically is what is required to be provided to participants when there's a change to the plan. Because the amendment time period is 2 years out, you're required, I'm just going to say this, I know it sounds crazy, but so the requirement to give that summary of material modifications won't occur until 2022. So, you know, how do you even let participants know that this is available? You know, if you want to be proactive about it, you know, again, we have this form that's going to be signed, or, you know, we did a piece that an employer could cut and paste some of the information from and, you know, send out. Again, I understand if you're not using email right now and they're all furloughed. I mean, the bottom line is if you add these features, there's not a mandatory notification to participants that they're available. So it would be more, you know, the employer's desire to make them aware that these items are available, rather than a mandatory requirement that if you don't do it, there would be fines and penalties and those types of things. So there is not at this very moment a mandatory requirement for an employer to notify participants that these features have been added. However, obviously, if your employees have been furloughed and you're trying to be helpful, you know, unfortunately, I'd have to say the mail is probably the only way, and it would just be, you know, something typed up, or, you know, again, I've already told Krista and Renee that they can share our piece, you know, which could be passed on. However, or you might have to cut and paste if you're not going to allow everything. But yeah, unfortunately, that's the only thing I can offer is really the best way that you can.
Okay. Another question that Jen pointed out is which amendments, at least for our PCSI clients, are going to be no charge and which ones will be for a fee?
Okay, thank you. Yeah, so our position, again, you know, typically when a client comes in and they want to make an optional change to their plan, which all these are optional, with the exception we're trying to get clarification on the RMDs, but the other ones are optional. You don't have to allow the coronavirus related in service. You don't have to allow the increased loans. You don't have to allow the suspension of loans. So all those to us in our typical workday are considered optional amendments. However, if a plan already allows hardships in service and or loans, we will add these features with a no charge amendment. So only a plan that really hasn't allowed any in-service type of thing or no loans would we charge. So if someone comes in and they don't have loans and now they want to add them, because we have to add the loans first and then we have to, you know, it's just more. That type would have our standard $350 amendment fee, but anyone who already has these features and they now just want to tack on these additional reasons, we will be doing that amendment at no cost.
If there's a plan that is, or a company that's struggling right now due to not being able to work, or, you know, just income not coming in, is there any relief or any provisions for plans that are struggling to fund their safe harbor requirements?
At this point, to know from this type of relief, you know, our associations are pushing for some additional relief. What is available, and again, you have to confirm how your plan document is written. So in most of our plan documents, we write the ability for an employer to suspend their safe harbor at any time. And I mean, that's in all of our documents. I think all but 6 we found. But that's in all our safe harbor documents. So irrespective of where we are today, just at any point in time, our clients could suspend it. Now, there's a lot of things that come with suspending it, and so you want to have a conversation. Just for a quick example, you know, we've had a client who was doing the safe harbor match based on, you know, what the people were deferring and the cost of their match. Had they suspended their safe harbor match, they would then be required at end of year to pay a top heavy minimum, and their top heavy minimum ended up more than what they were paying for their safe harbor match. So you got to be very careful and make sure you're having, you know, some numbers run and everything looked at. So first, your plan has to allow it, and it's primarily in the safe harbor notice. There should be a paragraph that says the employer reserves the right, you know, to suspend our safe harbor. If that language is not in your plan, then you can only stop the safe harbor due to adverse business conditions, which, you know, based on what you described, I would think that company would have adverse business conditions and could stop it. But again, I caution you to look at the overall effect and numbers. And then you do revert to testing, and, you know, it's not just stopping it for a month, you really stop it, and then 2021 is when you can start it again. So there's a lot to that. So I would just have a you know, work with whoever your plan's being serviced by, because just to come in and stop it could end up more costly than not.
Okay, thank you so much. Are there any more questions before we wrap up? I just want to give you all the opportunity. If you have anything that's pressing that you would like to ask, feel free. Okay, so I would like to thank Michelle and also Jen for joining. I know you couldn't hear her, but she's there. This is really, really critical information, and we wanted to make sure that you all knew what was going on and how it could potentially help you in the long run or help your participants. If you do have any questions in the meantime, please feel free to reach out to either myself or Renee. While we're not technically in the office, we are still working from home all the time. So we are always available, and you can reach us both either by email or by phone. And again, you know, we're here for you. So if you have anything, please, please, please feel free to reach out to us, and we are more than happy to address any questions or concerns that you or any of your participants might have. So with that said, thank you all very much, and we will be in touch.
Thank you, everybody.
All right, take care.